Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a part of our business development team here at ICM, and today I'm joined by Ken Shinoda from DoubleLine. Ken, welcome back.
Hey, thanks for having me.
Absolutely. So let's jump in and we'll start high level. Let's talk, if we can, about your current view of the general interest rate environment. Is the curve accurately pricing in your outlook for future inflation, any fiscal risks that exist, et cetera?
Yeah, I think we're, kind of near fair value across the curve, except for maybe the ultra long end. So we're pretty negative on the long bond. We've got a underweight there as far as duration positioning relative to the Bloomberg Aggregate Index. If inflation kind of spikes a little bit, but then moderates, as I think the Fed expects, then we're going to see maybe a cut this year. The market's basically pricing in 1 3/4 probability or 1 3/4 cuts by the end of the year. And so that puts like that 2-year at 4% plus or minus. So that's why it's been really stable on the front end, and really the vol that you've seen is in the back end, is not just in the US, but globally. Investors start worrying about fiscal issues and with different governments across the globe.
All right, so if I'm hearing you correctly, you'd really position fixed income portfolio on the shorter end of the curve.
Yeah, we kind of like that call it 2 to 7 year, more of that intermediate belly of the curve, underweight the 20 and 30 year. I mean, the 10 year is probably okay, but we're kind of the lower end of the trading range. I would get more excited about the 10 year if we got back up towards 5%.
Gotcha. All right, so with that, let's transition a little bit and talk about your view on the future path of the Fed. I mean, futures right now pricing in about 2 cuts by December and 4 to 5 total cuts by year end 2026. How realistic is this in your view?
Well, I think it really depends on how the inflation comes through, if any. So far, what you've seen, and even Powell mentioned this in his presser at the last Fed meeting a month or so ago, where there was a lot of pull forward of inventory purchases pre-April tariff announcement. So companies bought a bunch of stuff, and some companies are getting through that inventory now. Others maybe ate some of the price increases. So I think back to school is going to be a key critical pickup in spending that happens, and that's where you may see a little pickup in that goods inflation. So I think they really want to wait till that occurs, which is why they keep talking about like waiting for the data. I do think they want to cut once at least, and that could be by the end of the year. So I think the 1 to 2 cuts seems reasonable. It's hard to say, are they really going to cut 4 times next year? It all depends what happens to growth, jobs, so on and so forth. But I think that 1 cut seems totally reasonable towards the end of the year.
All right, good stuff. So let's transition just a little bit and get a little granular. I mean, mortgages have done relatively well year to date. Can you walk through performance drivers and kind of the current valuation environment?
Sure. Mortgages have done well. What you've seen is basically stabilization in rate volatility, stabilization in the flows out of mutual funds and ETFs, which really rocked the market in 2022-23, plus a bank failure with Silicon Valley Bank.
Sure.
And then also the deposits left banks as rates rose, because T-bills are earning you way more than your Chase bank account. So that was kind of the perfect storm that caused spreads to widen. Since then, rate vol has come down. The Fed starts cutting rates. Banks have stabilized deposits, become buyers again. Money managers are starting to see flows again. So everything has gotten better for the MBS environment. And as the Fed cuts, that makes banks get more excited about that steepness of the net interest margin and that curve, and you'll see even more bank participation. Wells Fargo had a cap on its mortgage buying because of some of the bad things they did over the last couple of years. That's been removed too, and they're a big mortgage buyer. So I think all net, the tailwinds, the headwinds have turned into tailwinds, and we're pretty excited about future prospects.
Great. So any opportunities in the mortgage-backed market outside of agency issues? I mean, does potential weakness in the housing market pose a risk to non-agency securities?
Yeah, I mean, it all depends when the loans are made. Much of what we own are loans from the past, and you have seen a lot of home price appreciation. So there's, seeing homes dip a little bit is of no concern. If you're buying new production, that would be where you are kind of at the most risk because it's at today's home valuations. But unlike 15, 20 years ago before the financial crisis, you have to put 20, 30% down. So loan to values are usually on the non-government guaranteed securities are somewhere between kind of like 65 to 75. So you have a lot of cushion in people that put money down that are not going to just walk away from their homes. So yeah, would a decrease in home prices be of concern? Of course, but I think they'll have minimal impact in the performance of the assets unless you saw 10+% home price depreciation nationwide, which I think is unlikely.
Okay, great. So let's bring this home. Any standout opportunities outside of the mortgage market that you're taking note of?
I wish I could tell you there was something super exciting, but we've seen a pretty big retracement of the spread widening that we saw in April after those tariff announcements. Equities, new all-time highs. Corporate spreads have tightened in a lot, almost back to the tights of the year. But that being said, I think in the securitized markets, and these are things that are backed by mortgage-backed securities, commercial mortgage-backed securities, CLOs, asset-backed securities. At the front end of the curve, you can still get paid, anywhere from like 100 to 200 over treasuries for really high quality investment grade type securities. So I think that part of the curve and those spreads for high quality assets, it's pretty compelling, especially you wake up and all of a sudden, the Fed cuts as the market's pricing in, Fed funds is going to drop, and a lot of those floating rate, short duration money market type accounts you're going to have missed out. So maybe you want to lock in at least like 2 years out the curve or something like that. And some of these, let's call it low duration type products as opposed to ultra short.
Great stuff, Ken. I want to thank you again for being a repeat guest. It's great to see you.
Likewise. Good luck out there, and everyone enjoy their summer break.
Absolutely. I want to thank our viewers for taking the time to watch this episode of Mic'd Up with ICM. If you have any questions or would like to suggest a future topic of Mic'd Up, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. And be sure to subscribe to this channel for notifications of new content as it arrives. Thanks for watching.